Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Are you getting your investment advice from Anna Kendrick, the actress? Let me repeat that. Are you getting your investment advice from Anna Kendrick, the actress, or from other Hollywood types? I saw an article this morning. LPL Financial is using Anna Kendrick as their spokesperson, as their contact to the public. I told my wife that. I said, Anna Kendrick now is giving investment advice. My wife looked at me and said, the actress? Who gives a rat's behind? Why do I care? What does she know about investments? I said, I don't know. LPL thought, she needs to be on the board or whatever. Anyway, I just thought that was interesting. And then there's another article out talking about how firms are having trouble attracting young advisors because of falling fees, lack of training, and a talent shortage. Not at Revere. At Revere, we're kicking tail, man. Ted and Connor and the young guys, they're awesome. They know more than the guy at Morgan Stanley that's 50 years old, right? And I've got people knocking down my door with finance and accounting degrees that are young and hungry. So there are a few young kids out there that really want it and are hungry. That's not true. At Revere, we may raise our fees if we still have this success we're having, we actually may be raising our fees, not lowering our fees. See, if the pie charts are us crowd, you get a 7%, whether it's asset allocation, target date, balance fund, or some arbitrary rebalancing, you're going to get a 7% average return. You're going to have to deal with 35% drawdown every 5 years. You know what I'm talking about. Versus low double-digit returns with no bear markets ever. So if you want your money managed just like our money, and the name of our podcast is Your Money. Wall Street thinks it's their money, and they take it, and they take your money, and they diversify to all their real clients, the muni bond, the emerging market, the tech stocks, and that's their real client, not you. You're the product. You're the cattle. They're delivering you to market. They're spreading your money amongst their clients and giving you rotten fruit along with the good fruit for a balanced portfolio. I don't want rotten stocks. I want good stocks. And when it hits the fan and it's ugly across the board, I don't want any stocks. You know what stocks I like? Stocks that are going up. You know what stocks I hate? Stocks that are going down. Therefore, I have to have rules to determine when a stock is likely or have a higher probability of going up and when it has a higher probability of going down, not just buying a random pie chart of a bunch of crap, and hope for the best. We don't do that at Revere. It's a little bit different. It's a lot easier to ride. Our retention rates are incredible. And if you want a better way to invest and you're tired of losing 35% every 5 years or so, then come on board. So with that, I'm going to go to the team. And here's the whole thing. I had a guy call me the other day, and he's looking at this, and he's trying to analyze this, and he wants to look, and look, you should audit us. You should look at, I'll be happy to share our returns, our drawdowns, everything. Because we are worth it. We're good, right? And so he's calling, he's analyzing me, and I've had 4 or 5 people do this in the last week. And so finally I said, well, wait a minute, what do you have? Let's talk about you. What are you doing? Let's analyze what you're doing. He's got a 60-40 balance fund. I said, you kidding me? You're making 7%. You're down 35%. That's why you're calling. And he started like, well, yeah, right. That's right. Call. If you're making single-digit returns and getting slaughtered every while, give us a call. Because price is truth, no exceptions. There's only the right portfolio for the market now, and then that will change. It's not based on your risk tolerance and your time frame. It's based on the market's time frame. Now, you need to align your time frame with the markets so that you don't get run over. But then also it's all about the market risk, sector risk, or stock risk. So just because I'm super aggressive, should I hold a crashing stock? I don't hold crashing stocks. That's dumb. So just because I'm aggressive, I should hold a crashing stock? No. You need to have rules so that it's a much easier smoother way to invest with a higher equity curve. And with that, I'm going to go to Don. And by the way, congrats on Don. Don did an IBD Live show this morning right before this show. By the way, Don, congrats. We got about 25, 30 new signups for the newsletter in the last 20 minutes and a few people that want portfolio reviews. But anyway, Don, take it away, man. Show us why Revere is a better way.
I'll show you why, Dan. You know what? How about real quick?
I'm sorry. I forgot to tell everybody. I'm actually an Airbnb in Salado, which is one of the oldest towns in the hill in Central Texas. That's actually the state of Texas made out of wasp nest. So in any event, if it wasn't so loud outside, I was going to take this outside. We're right by Salado Creek. It's beautiful outside out there. It's just gorgeous. But anyway, that's why it may sound a little bit remote if you're listening and you're not seeing this on video. Anyway, go ahead, Don.
Dan, I'm going to run through, if people aren't subscribed to IBD Live, I'm going to run through the 15 slides that I reviewed very quickly. And it gives a feel for our high-level approach here at Revere. We're statistical based. One of the main things that the way we approach the market is, what is the optimal position size that we can take without getting shaken out on a major reversal on a normal pullback. We want to be able to hold what we can and not get shaken out. And the RVAB formula, Revere Volatility Adjusted Beta, we discuss this every night in videos. It's a combination of a stock's beta and its average true range, which is how volatile it is intraday. I'm going to quickly go through these slides here. So this is the formula, RVAB. And really what I'm doing, this is an anthology of what I presented on IBD Live. This is the 4th time I've been on and the 5th time I was on their podcast once. So RVAB, this is an example of how we buy things on a pullback that are in strong uptrends, the 60-minute stochastic. This is an example of our balance at risk, rebar. We discuss this every night in the videos. It's what would happen if we woke up tomorrow and all of our stops got triggered? How much would the portfolio be down? This is a snapshot of the current portfolio. Positional risk parity. This is a calculation for how we spread risk across different tickers depending on how volatile the ticker is. In other words, a 4% position in a less volatile stock can be the same volatility as a 2% position in a high beta stock. This is my dog fast asleep. Sleep well at night. This is what we strive for our clients. When they lay their heads down on the pillow, they don't have to worry about having their downside protected. They can sleep well at night. These are the last 14 bear markets. This is what we pride ourselves on avoiding. They all occur under the 200-day moving average. We talk about it all the time in our videos. This is the trend gauge that we present every night in our videos. And it's just a matter of how we go from no exposure when the market is in a severe downtrend. This was back in late March to where we are right now when the market turns and starts going higher. It's just a matter of exercising all of the rules that we have in place for getting into the market when it's strong, getting out of the market when it's weak. This is the 10 steps from bottom to bull. We checked off 9 of them. The only thing left to go to a fully bullish technical configuration is for the 50-day moving average to cross up through the 200-day moving average on the S&P, and I'll take a look at that very quickly. This is our current portfolio holdings. We discuss them every night in video. Most transparent advisor in the country. This is our new rules for getting in the world. Okay, for getting back into the indexes off the bottom. One of the things from our studies is we thought we could improve exposure off the bottom, and this is the rules-based approach for doing it. This is an example of 2 stocks that we sold on strength this week as they just got too extended to the upside. And then we ended up buying them back yesterday because they did the 60-minute stochastic cross. So we ended up buying them back cheaper from where we were able to get out. And these last 3 are just examples of how stocks ride the 8-day moving average higher as they do their strong runs when the market is in a strong uptrend. This is GEV, which we own, Tesla, which we own, and Guidewire, which is in the 2121 list, but we don't own. So those are the 15 slides that I presented on IBD Live. Now let's go to a live shot of the S&P 500. And really everything that I just went through with those slides is being played out in real time, and we update it every night in the videos. The market changed on April 22nd and 23rd with those follow-through days, and it had a slingshot to the upside, and we've been able to participate every step of the way after getting out of the way using our exit rules. A lot of these people that say you can't time the market say you have to be right twice. You have to be right getting out, and you have to be right getting in. No problem.
And Don was a twofer. He nailed both of them.
No problem. We've got rules, time-tested rules based on exactly what goes on in the market. It's not opinions. It's how the market works. Get out of the way on the downside, readjust, and participate when the market starts going up. That's why our flagship portfolio is called Growtection. Grow assets on the way up, protect them on the way down. It's a common sense approach. What other part of your life when things are going bad do you not take action? Do you go dressed out like you're going to the beach in the winter? No, you vary your outfit the same way you should vary your portfolio depending on what the market conditions are. That's what we're all about here at Revere. We just crossed $250 million in assets under management. That's double from where we were just 15 months ago. And it's a combination of new people coming on board and big growth that we've had in our portfolios by following this process all throughout 2024, starting in late 2023, dodging the bear market that we just had and getting back in.
Don, real quick, hang on. I want to explain, Matt. I want to put a number to that so the listeners understand that. That pullback that we just had a month ago, not we, Revere, because we didn't have it. The market, the S&P had it. Now, it wasn't technically, I don't think, Don will know, a bear market because it didn't close below 20% any given day, but intraday it closed below 20%. So if you're watching, you still had that bear market, but it closed down around 19, whatever. We were down roughly 8.5. We didn't even break double digit. Then when the market shifted, he got back in very quickly. And right now I think we're beating the S&P this year or close to whatever, right in line. You didn't feel that pain. You felt literally roughly a third of that pain. Same thing during COVID, same thing during the 2022 bear. So we're essentially matching S&P-like returns, but with a third of the drawdown as experienced by the last 3 bear markets. If you want facts on that, call me. That's the difference. The other difference is if you have a little pie chart or us portfolio that's making 7-8% versus even 10 or 11 or whatever, that 4 or 5% differential a year can be hundreds of thousands of dollars on the back end in retirement. So put a number to it so you don't just feel emotional. I got clients, I ask people, traders all the time, how's your portfolio doing? Oh, well, it's okay. It's not. No. What is it? If you're really a trader, if you're really managing your own money, you should know down to the 1/10 of 1% year to date what your portfolio is. If you don't know that, you shouldn't be managing your own money. All right, Don, sorry, I couldn't help it.
Yeah, and regarding the S&P, all of our strategies are significantly beating the S&P during this bull period that started in November of 2023. And I think it was 9.2% was our pullback during this most recent move off of the highs. But it's that -9 to the -21. That's where the pain is. That's what we have avoided. It was basically this 5,500 level when we broke below that on the Trump tariff day. But it was an overreaction. We had a big, the market can only get stretched so far to the downside before it snaps back. It did. We retested over the next week and a half. Then we had classic O'Neill follow-through days, and just following our rules got us engaged back to the upside.
Hey, I've got one question for you because you brought it up, and I wanted to pull back the curtain a little bit. When you get in what they call a strong primary uptrend, folks, for you non-IBD followers, that means it's a really strong short-term burst in the markets. Don, when you get in a primary uptrend, you always talk about you're riding the 8 EMA because that's kind of the pattern of the stocks, the growth stocks that do that. So in different markets, you're normally focusing on kind of different moving averages. Is that an accurate statement?
Yeah, the leading stocks generally ride the 8 EMA during the bulk of their strong gains. The indexes, the S&P, you want to see that riding the 21-day moving average. That pulls back
Okay.
below. It
And,
doesn't get too far
and that's
extended
because it's
above
more
the 8 or
diversified.
below
Yeah.
the 8.
And
Yeah,
that's what I
Todd's
want
going
our
to talk
listeners to
about.
know.
Yeah, Todd's going to talk about that power trend that we had that started back in 2023 when he does his presentation here shortly. So that's the indexes. We're going to go to Connor now. He's got some awesome charts that we're going to go over for the listeners we own in our portfolios. Many of the ones that we don't are very high on our watch list. Take it away, Connor.
Yep. So segment for today, I want to talk about setup theme. And this is something that, generally I don't hear talked about in the trading community a whole lot. We talk about groups and, industry groups a lot, like multiple stocks in the same sector forming. But, there's not a lot of talk about setup progression, and setup theme is kind of like what the term I like to coin it on. So we've seen kind of the progression of these setups happen as the markets came off the lows, and the one setup theme that we're seeing right now is just kind of names at the highs, breaking out at a huge multi-week basis and not giving back whatsoever. OKTA is a perfect example, and this one also has, it also has the group strength with other cybersecurity stocks. So this one's sitting at the highs, and then if you look at a name RBRK, this is another cybersecurity stock. This one is sitting right at highs as well, and you can see how similar it looks to OKTA, which same setup and same industry group, and that's kind of will give you better odds for trading that stock and more conviction. And then one name that's not in this group is Uber. And this one, again, very similar chart setup, breaking out of a big base, falling through to the upside at all-time highs. So when you see multiple stocks with similar patterns working, that is a sign that, it is a healthy market and that the market is rewarding buying strength right now because, if you would have bought these breakouts, they have been working. And and then the other setup theme is kind of some names that could use a handle. There's a lot of cups in the market right now. And if you pull up a chart of Hood, this is a perfect example that there's a handful of other stocks that look like this. They started with that undercut and rally, double bottom undercut and rally. Then they broke out of a double bottom base, and then they formed a flag. And now they're coming up the right side against that previous left side peak. And so, maybe these just blast through. It bounced off the 8 EMA yesterday. It's falling through today. Maybe it just blasts through that left side high, or maybe it handles, lets the 21 50-day catch up a little bit more, but nevertheless, super strong chart. Another chart that looks almost identical is GEV. And this one actually rallied back up into that left side high. And you can see it just about tapped it. And then it's just forming a really nice handle flag, digesting on super low volume, and letting that 21 50-day slope up more and catch up to price. And then another one is Carvana. And this one's kind of sitting at highs as well, trading right at that previous left side peak, and this one's starting to handle out as well. So, there's a lot of cups in the market. So, with our bullish tone, to stay bullish, these names, any pullback should get supported to the 8 or 21. The pullback should be on light volume, and it should just generally be orderly price action. And then, Don, you just pull up a chart of the S&P 500, and you can kind of illustrate this when I talk through, but kind of what I want to emphasize is the setup progression that you tend to see in markets. Obviously, we have our trend signals with the moving averages and leaders, but you tend to see a similar cycle in stock. So if you're coming from a long-term bear market, the setup theme is going to be big stage one bases. And why is that? That's because the market's been going down for months, and that's when you start to see stocks start to build higher lows in huge bases. This is exactly what happened in 2022 as the market was making new lows. You just had tons of names in, year-long basis setting up. NVIDIA is a perfect example, and that's when it kicked off its run. So that's kind of is the first iteration after a long bear market, which 2022 was quite some time. And then fast forward to today, we had a relatively short 20% decline. And the setup theme that you tend to see after a quick 20% flush is these undercut and rallies, and double bottom bases. And certainly, if you've been following us, 2-3 weeks ago, we were talking about how there's so many double bottom bases, undercut and rally setups. And that's kind of what you tend to see after a short-term flush. And then after those double bottom bases start to work, you start to get those tight consolidations. So once these stocks get back into stage 2, you start to see those 3-4 day pullbacks into the 8 or 21. And that's exactly what we're seeing right now. Hood, HIMS, perfect examples of strong moves up and now just like kind of high type flag consolidations. And then lastly, how do stocks top? You basically get toppings when you start to see parabolic advances, stage 3 distribution. So I kind of put this little setup progression thing together last night, and it helps a lot to visualize what stocks are doing, where you're at in the market cycle, and it adds edge, combining leaders, indexes above moving averages, market health, market sentiment. So if you look back at charts, I found this setup progression, setup theme to play out time and time again in market cycles.
Yeah, it's 100% accurate. Would you say that this is a hard penny environment or more of an easy dollar environment that we're in?
Definitely easy dollar.
Yeah, I think we've made 15 purchases in Grotection, and the only 2 that we've gotten stocked out of are Penumbra, because it didn't make any progress, and then that was a preview to this breakdown that it had over the last couple of days. And
Price is truth.
Price is truth. Crowd, Connor just showed OKTA and Rubric are outperforming this. I got stopped out on this when it pulled back last week. It has bounced a little bit, but the relative strength is lagging against Rubric and OKTA, and Zscaler also in that group is outperforming it. So yeah, look for the best stock in the strongest sectors, and Crowd was that for a while. You can see from this relative strength line, but over the last 2 weeks, it's faltered. Still a decent setup, no question about it. But do you want to be in the 4th or 5th best stock in the group, or do you want to be in the number 1? We'll take number 1 or number 2.
And by
Good
the way,
stuff,
Don,
Connor.
that's the whole point. Hey, but by the way, I just want to reiterate that. So price is truth. We don't pre-select securities. Securities have to earn their way onto our portfolio. And then once they earn their way on their portfolio, they got to continue to earn their way, stay on the portfolio. They got to be first string or they're cut. That's what Don just said. That stock wasn't acting as good as some others. It's gone. It's gone. Price is truth, no exceptions, period. If you're arguing with price, you're arguing with truth. And that's the whole point. Is your advisor or you working your butt off like Don and these guys and doing it 2 or 3 hours before the market opens through the close, or is your advisor asking you for a tea time and lunch? That's a question you got to ask yourself. Sorry, Don, I can't help it. I'm on fire.
All good, Dan. All right, let's turn it over to Todd. He's going to talk about the Powertrend that started in November 2023. Are we entering another Powertrend? Time certainly will tell, but what are the odds telling us right now, Todd?
All right, well, the odds are telling us that we are potentially going to enter an even easier penny environment as early as today. So I want to talk about the IBD Market School Powertrend, and I want to go over a little brief history of how it became about, and then we're going to go into today's market and show you what turns on the power trend. And then we're going to go over an example of the last power trend that began in November of 2023 and ran through the summer of 2024. So just to give you a quick background on how it developed, the IBD got together, Mike Webster, Charles Harris, and Justin Nielsen set out on a project about 12 years ago to determine and analyze 100 years worth of market index history to see if there were periods of time that were more bountiful than other periods of time. And over the years, they noticed that there were times where Bill O'Neill would get really nervous about 4 or 5 distribution days and he would sell everything. And then there were other periods where Bill would allow 7 or 8 distribution days to stack on and not be concerned. They really wanted to go back and look at all the model books, all the index history to find out what was unique about those periods where Bill didn't panic out of heavy distribution. Well, as a result of that project, they developed what they call the Powertrend. And I was lucky enough to attend the workshop back in 2015 in Hollywood, Florida, where I spent 2 grueling days of about 12 hours each day and listening to Mike Webster and Charles Harris go through all the details of it. So if we look at the current market, Don, let's start off with 5/16/25 today. And let's talk about what is required for the power trend to take place. Well, first of all, the 21-day moving average is above the 50-day moving average for at least 5 consecutive days. Okay? Now, the first day was 5/9, where that took place, where the 21 was greater than the 50-day. And yesterday was day 5. So the earliest we could enter the power trend was yesterday. Don, if you could go to the NASDAQ, please. I'm going to go into the NASDAQ because the power trend's based on the NASDAQ. So as a formality, we missed the power trend yesterday because it was a slightly down day. But in spirit, Mike Webster considers it a power trend anyhow. Now, the other requirement is the 50-day moving average has to be in an uptrend for at least 1 day. And the 50-day started upsloping on May 12th. So we qualify there. And then the index low has to have been above the 21-day moving average for at least 10 consecutive days. And that took place on 5/7. So it's looking like we have the possibility of entering an official power trend today. Okay. So we already know we've had a follow through way back in April. You know, we've had breath thrusts. But now we're going to go back to the most recent power trend. And I'm going to ask Don to go back to August 1st, 2024. And I want to also say that the reason the power trend's significant is because it shows historically a period of time where the market has had abnormal strength throughout this period. And it allows you to kick up your exposure, to act more aggressively, to potentially go on margin during this time. But it also allows you to give more leeway to your leaders and hold them for longer periods of time to potentially stretch them into much bigger gains over the cycle. So if we go into this particular period, the power trend started officially on 11/22. Okay, but before that, we had a follow-through day on 11/1. And that's the follow-through day that Don references of the start of this current bull market, which has been quite strong. And throughout this period of time, this power trend did not end until the 21-day moving average ultimately crossed below the 50-day moving average toward the end of July and the first part of August. So actually, Don, that period you're referencing, we were still in a power trend because we had so much strength coming into that period, and we didn't violate all the rules of market school that kicked us out of that power trend in April. And it's a pretty complicated system. You can subscribe to the course on the IBD website and go through all the details of it. And it's a whole bunch of, it's like keeping score and adding like credits to once you're in a power trend, it takes a lot more for the market itself to go into correction mode. So we really didn't end this power trend until we started that breakdown at the end of July and the first part of August. So during that period, I just want to bring up a couple names that showed exceptional performance during this time. And I'm going to start with AMD, Advanced Micro Devices. Now you can see that AMD had a huge breakout on the follow-through day on November 1st and actually doubled from that time. So again, this started running well before the power trend took place, but the power trend would have helped you stay potentially in that trade throughout the whole duration and not get shaken out. Okay, so that's what's important. The other major stock I wanted to show was Uber back then. Uber was another one that broke out right around a little bit before the follow-through day, actually. But this is another name that started and was a stock that you could have rode into a pretty decent gain throughout the power trend. And let's just go over one last one, Don. Let's put in NVIDIA. And what's interesting about NVIDIA is it didn't really go until January. It really set up in a very nice flat base, and it finally broke out on January 6th and went into a huge run. So the good news is you don't have to be in everything when the power trend or when the follow-through day hits. There's a lot of leaders that'll set up in the upcoming weeks and months ahead too. So that is what I wanted to talk about today. Thank you, Don.
All right, good stuff. And it still blows my mind. I remember doing the videos from November of 2023 until April of 2024. The S&P 500 staying above the 21-day moving average for 6 full months. I remember just increasing the count every day because we discussed that. That's one of the key metrics that we show on our videos every night. This power trend could just really be getting started. Imagine trending 6 months above the 21-day moving average again. Obviously not saying that's what's going to happen, but we've seen it happen before. And talking to Mike and before IBD Live this morning, he said there's actually 2 periods. He didn't remember the exact dates. There were 2 periods that it stayed above the 21 for even longer. So it certainly can happen. The market can go higher than you ever imagined. It can go lower too, as evidenced by what happened in the great financial crisis. But for now, the wind is at our back, and we're absolutely taking advantage of it. That's it from the technician side. Dan, you can take us on home.
Thanks. Listen, what Don was just saying is so apropos. I say at the beginning of the show, in the intro, you hear it. I say the markets always shoot to the upside and the downside, right? Because it's emotional. I hate to tell you, look, I've got all kinds of hoodly doodlies behind my name. I got a CPA background. I never did public accounting, but I passed CPA exam, got my experience. Then I got my CFA. I've got 12, 15 years of higher education, hoodly doodly, fundamental economic, intense background. I can do valuations 50 different ways, right? Fundamental. Problem is, doesn't help me make money. In fact, a lot of times it gets in my way. Sometimes Wall Street and Main Street are not in sync. Sometimes they are. That's why Price is Truth, no exceptions, makes it a lot easier, because a lot of times I'm wrong. Look, I'm a great economist. Hell, I'm even right sometimes. None of the best economists in the world make good money. Harry Dent's a great economist. He's a terrible money market. Launched 2 ETFs, had to shut him in 6 months. This is very difficult. Here's the other thing. Everybody's scared because of Trump tariffs and the media is hyping everybody up. So you're scared about the market right now. Guess what? The market does not care about you. The market is rallying now. It's setting up, and it looks like it wants to go a lot higher. Now, it may not. It may turn around tomorrow. That's why I got a parachute. That's why I can sleep at night going all in and even going 150 or 200% longer than the S&P at certain times. And then covering up and going not long at all and being in cash. Money is not made evenly. There's spurts in time when the markets make a majority of their gains. Last year's gains, hell, most of it was in January and February. Most of the gains last year. Okay, a lot of them. There were some other gains, but all I'm saying is money is not made evenly. This is a much smoother way to do it. We're a fiduciary. There are no conflicts of interest. We're not doing proprietary funds or fees or anything. But more importantly, your money looks just like my money, down to the percentage of every position in the portfolio to the return, except I don't charge myself a fee, so I'm gross and you're net. Other than that, your performance will track just like Don's wife in Grotection or my 92-year-old mother, or in Turbo. I've got some money in Turbo too. Be just like that. Exactly. You don't customize portfolios to the individual. You customize portfolios to the market, because it's what the market's doing tells you what you need to invest in. Okay? So if you want a better way to invest, if you want to learn just about Revere, just go to revereasset.com. Up in the right-hand corner, there's a subscribe button. Just put your name and email in there. Make sure it goes in, and you'll get our daily market insight video every night the market's open. These guys do a video for you, complimentary, telling you what we're doing in our portfolios. In fact, a lot of clients go, man, this is the coolest thing. I've been following you for months. And now I feel in real time what you guys are actually saying in the newsletter. The newsletters come alive, so thank you. Okay? Then next to that, there's a subscribe button. If you want to, contact us button. If you want a complimentary portfolio review, or you want us to talk about a stock or a topic on the show, reach out and ask me that. We're the most transparent advisor in the world. And you can always call us old school at 855-REAL-WEALTH. Folks, we will talk to you next week on your money, not Wall Street's money, your money.
It's not about how much you make in the markets, it's about how much you can keep.